Okay bro, welcome to the new video. As you can hear from my voice, I'm a bit sick, so I will still try to make the best quality possible. But nonetheless bro, let's take a look at this company today called NextEra Energy Incorporated with the stock ticker NEE. And as always, we will take a look at the most important financial statements, meaning income statement, balance sheet and cash flow statement. We will analyze the most important bullet points from each financial statement. Then all the data that we analyzed here can be found on this website called Macro Trends, and as always bro, all the links are going to be in the description. So without further ado bro, let's take a look at the income statement, or more particularly let's take a look at the total revenue, okay? And one little detail, we will always analyze the data for the last 10 years because this will give us a better perspective of the development of the company, how they are performing and where the trend is going, okay? And based on the data that we analyze, we will then decide whether we should buy or sell the stock, okay? And now let's take a look at the total revenue. And total revenue, as you can see on the graph, it's growing a bit and then falling a bit and growing again. But overall the trend is going upwards, okay? So we will mark that as a buy. And now we come to the gross profit. Gross profit is similar to total revenue. It's first growing a bit and then falling and growing, but the trend is again going upwards, so we will mark that as a buy as well. And now we come to the gross margin, and gross margin is basically calculated by dividing gross profit with total revenue, and preferably bro, we want this to be more than 40% in the all 10 years, okay? And as you can see here in the graph, it's more than 40, it's around 60, 70, even 80. And right now around 70%, so this is definitely a good sign, so we will mark that as a buy. And now we come to the operating income. Operating income basically represents all the income that will become part of the total revenue in the future, okay? So this is basically the future income, okay? And preferably we want this to be also growing through the all years, but as you can see here, it was growing a bit and staying quite high, but right now it's for some reason lower in 2021 and 2022, so we will mark that as a sell because it's a bit inconsistent and I don't know what's happening, but based on the financial data, it's a sell, okay? And now we come to the net income. Net income, similar story bro, it was growing a bit and then growing massively in 2017 and 18 and then falling again in 2019 and 20, and right now it's also slowly growing, which is a good sign but not good enough, so we will mark that as a sell as well, because here I want to explain you something, okay? When we evaluate the company, we want to be as harsh as possible when evaluating it, because even if we are then wrong for some reason, we still have that extra margin of safety, you know, we still evaluated it a bit harsher, so it was actually better than we expected, okay? And this will give us basically that free room to maneuver, you know what I mean? And now we come to the net income margin. Net income margin is basically calculated by dividing net income with total revenue, and we want this to be more than 20% through the all years. And as you can see in the data and also here in the graph on the bottom right, you can see that first it was growing and then it was well above 20%, maybe how much, 50, 40, and then it fell again massively, and right now it's stabilized around 20, 21%. So we will still mark that as a buy because it's more than 20%, but with cautious because okay, maybe it will fall down, maybe it will go up, because you can see that this company easily reached 40%, so it is possible, okay? And now we come to the capital expenditure divided by net income. This basically means how much net income they produce by each investment that they do into the company, meaning when they buy new equipment, when they expand the business, when they build new factories, and so on and so on, okay? And as you can see, this ratio is also growing a bit. It's around 4 right now, so we mark that as a buy as well. And now overall bro, income statement has 5 buys and 2 sells, so we mark income statement as an overall buy. And now we come to the balance sheet, and here we will start by analyzing long-term debt. Long-term debt should preferably be always lower through the all years, okay, so lower and lower. But as you can see here in this company, it's growing through the all years, so that's a bad sign because they have more debt than in the previous years, okay. So we mark that as a sell. And now we come to the retained earnings. Retained earnings are basically all the money that the company invests back into the company instead of paying it as a dividend, okay? So that basically means that the company is reinvesting the money back into themselves, okay? And preferably, we want this to be growing through the all years. And as you can see here, the growth from 2013 to 2018-19 was quite impressive. And right now it's stabilized around, how much? 25,000 through the all last 4 years. So we will mark that as a buy, let's say, because you can see on the graph that they were investing more and more money back into the company, okay? And now we come to the total equity. Total equity should be like growing through the all years, which is quite straightforward. And it also is growing, so we will mark this as a buy as well. And now we come to the return on equity. Return on equity is calculated by dividing net income with total equity, okay? And we want return on equity to be always higher than 10%, okay? And as you can see here in the past, it has been around 11, 12, 18 even, but right now it's falling. It's right now almost below 10, it's 9%, so we will mark that as a sell, okay? Because we want to be as harsh as possible. And now we come to the total liabilities, and total liabilities are actually all the costs, all the debts, all the payments that the company has to make, you know, so basically all the outflows that the company has. And bro, as you know, we want this to be as low as possible. And as you can see on the graph, it's growing through the all years, so this is a bad sign, so we will mark this as a sell. And now we come to the debt to equity ratio, which is calculated by dividing long-term debt with total equity. And we want this to be lower than 50 or at least lower than 60% through the all years. And you can see here on the chart, bro, it's around 100, 110, 90, 114, so way above 50%. So bro, we must mark that as a sell, definitely, man. And now we come to the conclusion of the balance sheet. So the balance sheet has 4 sells and 2 buys. So we mark balance sheet easily as a sell, okay? And with that being said, we come to the cash flow statement, the last financial statement that we will analyze. And here we will analyze capital expenditure as the first bullet point. And capital expenditure is basically all the money that the company invests into the company itself, okay? Meaning that they buy new equipment, new machines, new computers, they buy new land where they can build the factories on, they buy new lorries, new cars, basically expanding the business, okay? And this capital expenditure should be growing through the all years. And as you can see on the graph, first it was growing a bit, then it was quite low, and then massive growth. So that's a good sign. That means that they are investing a lot of money back into the company. So we will mark that as a buy, definitely. And as you can see here, from 2019 to 2022, they have quite high capital expenditure, which could explain why also their debt is so high and why their debt ratio is more than 100% in the last few years, okay? And now we come to the stock dividends. So this company is paying dividends, but around 60, maybe €1 per year, which is a good sign because it was growing, the dividend payments were growing, but right now, bro, in the last 2 years, they were falling massively. So they are quite low, and this is a bad sign, okay? I don't know what's happening in the company. Maybe they are investing back the money to the business. This is why the company is paying such little dividend. I don't know, bro, we have to take in the annual report, but yeah, I don't know, this is a bad sign, bro. First it was growing and then suddenly it's low, so yeah, that's a sell, bro. That's a definite sell, you know. And now we come to the P/E ratio comparison with the 8 companies that have the biggest market cap and are also direct competitors of the NextEra, okay? And basically what I did here is I took the P/E ratios of all those competitors and then I calculated the average, and the average P/E ratio is around 16-17, okay? And preferably, bro, we want the P/E ratio of the company to be lower than 15. And the P/E ratio of this company itself is 16, and bro, still it's a bit lower than that P/E of the competitors, which might hint that this company is slightly undervalued. So this might mean that it's maybe a buy, okay? And I prefer to have all the companies that have P/E ratio below 15, and this company has 16, which is just one above. And still, bro, we want to be as harsh as possible, so we mark that as a sell, okay? And now we come to the last bullet point, which is intrinsic value. Intrinsic value basically means the price of the company that it's still not undervalued, okay? This is basically a fair price of the share. The price, how much the company should cost right now, okay? And as you can see here, the value is around $93, and the real price right now of this company is around 57.81 cents, okay? So this company, bro, the NextEra is trading around $40 below the fair value. So this company, according to the intrinsic value, is massively undervalued, sorry. So we will mark this as a buy as well. And now the cash flow statement has 2 buy and 2 sell, so we will mark this as a sell as well, because we want to be as harsh as possible, okay? And with that being said, bro, now we come to the final evaluation of the company, and I think that this company should be on your watch list, okay? Because as you can see on the chart, for the last 10 years the price return was 140%, bro, meaning if you would buy this company right now here in November 2013 and then sell it right now in what is this data for, October 2023, altogether, man, you would get 140% price return, okay? 140% profit. But if you would buy this company for each month, let's say for $100, basically with dollar cost averaging, then altogether your return would be 9%. Dividend yield is also okay-ish, not the best one, it's around 3%, and preferably, bro, if you are a dividend investor like I am, you want to have dividend yield of around 5%. And overall, I think the income statement is really good, the gross margin is good, the net income margin is good, debt to equity ratio is bad, to be honest, like it's above 50, above 60%, which is terrible. The return on equity, it's also kind of good, you know, it's around 10%, which is preferable. The intrinsic value is amazing. So this is a tough decision, bro. So I think that you should put this company into the watch list and then see how it develops in the future, okay? Maybe if you are a bit impatient and maybe if you want to invest into this company right now, then start to invest like small amounts, okay? Start with investing, I don't know, 30, 40 euros, maybe 50, and then see how it develops, okay? But with that being said, bro, do the hard work and see you on top of the world.